Kansas Property and Casualty Practice Exam. Welcome to the quiz. What does the vacancy clause in a property policy often stipulate? Is it A, it provides additional coverage for vacant properties? Or B, it may suspend or limit coverage if a building has been vacant for a specified period, e.g., 60 days. C, it lowers the premium for vacant properties. Or D, it requires the insured to notify the company if a tenant moves in. The answer is B. Empty buildings face higher risks like vandalism, theft, or undetected damage. No one notices leaks. Many policies reduce or suspend coverage, e.g., no coverage for vandalism, theft, glass breakage, water damage, if vacant over 60 days unless endorsed. It doesn't add coverage or lower premium. Notification for tenants is occupancy-related, but vacancy limits aim to address increased empty building hazards. Next question. What is the primary purpose of a loss payable clause? Is it A, to protect a lender's interest by directing claim payments for property damage to the lien holder? Or B, to expedite payment to the insured? C, to allow the insurer to pay a loss in installments? Or D, to specify who is financially responsible for a loss? The answer is A. When property is financed, mortgage, auto loan, the lender has a security interest. The loss payable clause, or mortgagee clause in some forms, ensures that in the event of a covered loss, the insurance payment is made to the lien holder, bank, first, up to the amount owed, to protect their collateral interest. Any excess goes to the insured. It does not speed payments, allow installments, or assign responsibility. The clause safeguards the lender by directing proceeds to satisfy the debt. Next question. What does Bailey coverage protect? Is it A, a business that holds property belonging to others, e.g., a dry cleaner? Or B, a business that ships its own property? C, a property owner? Or D, an employee? The answer is A. Baileys, like cleaners, repair shops, warehouses, have care/custody of customer property. Bailey coverage, often inland marine, protects against loss/damage to that property while in their possession due to covered perils. Not owned shipments, cargo, owners, or employees. Bailey covers liability/exposure for others' goods entrusted to them. Next question. What does host liquor liability refer to? Is it A, liability arising from serving alcohol at a private, non-business function where no fee is charged for the alcohol? Or B, the liability of a bar or restaurant? C, coverage for a host's personal liquor collection? Or D, an exclusion for all social host liability? The answer is A. CGL excludes most liquor liability for businesses selling/serving alcohol. Host liquor liability, exception or endorsement, covers non-commercial hosts for BI/PD claims when they furnish, not sell, alcohol at private events like parties or weddings. It protects social hosts. Not for bars/restaurants, need liquor liability. Not liquor collection. Not full exclusion. Host liquor covers non-business alcohol service liability. Next question. What is the primary coverage provided by a difference in conditions DC policy? Is it A, it fills gaps in primary property coverage, often covering perils like flood or earthquake excluded in standard policies? Or B, it covers differences in insurance conditions between states? C, it provides excess liability over underlying policies? Or D, it covers conditions that cause a difference in temperature? The answer is A. Standard property policies, like commercial or homeowners, exclude major catastrophic perils such as flood, earthquake, war, or nuclear events to keep premiums reasonable and avoid insurer insolvency from huge simultaneous losses. A difference in conditions (DC) policy is a specialty follow-form or standalone coverage that picks up many of those excluded perils, providing broader protection for large or international risks. It is commonly used by multinational companies to ensure consistent worldwide coverage where local policies might differ or exclude key perils. It does not address state-by-state condition differences. It is not excess liability, that's umbrella. Temperature differences are unrelated. DC primarily bridges gaps in excluded perils on underlying property coverage. Next question. What is the primary purpose of a fiduciary liability insurance policy? Is it A, to cover liability of those who manage employee benefit plans, like 401k plans, for errors or breaches of duty? Or B, to ensure the fidelity of employees? C, to cover liability of company directors? Or D, to provide liability coverage for financial advisors? The answer is A. ERISA and common law impose fiduciary duties on those administering employee benefit plans, pensions, 401k(s), health plans. They must act prudently, diversify, follow plan terms. Fiduciary liability insurance, ERISA fiduciary liability, covers defense and damages if they are sued for breach of those duties, e.g., poor investments, mismanagement. Employee fidelity is crime bonds. Directors are D&O. Financial advisors may have E&O. Fiduciary liability specifically protects benefit plan fiduciaries from liability for plan-related errors or breaches. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.